Hello guys, welcome back to my channel. Don't forget to like, share, comment, and subscribe the channel. The Fed's last rate hike 5 ways Americans may feel the pain. The Federal Reserve on Wednesday delivers its third straight 75 basis points interest rate hike in its campaign to drive borrowing costs hike enough to bring down 40-year high inflation. The goal to get businesses and households to pull back on spending and reduce demand for goods. Surveys and labor therapy easing upward pressure on prices. But the process won't be smooth. Regular Americans have felt the sting of inflation for months, and the Fed's efforts to lower it so far have already made it harder for many consumers to buy things like a house or a car. Other shoes have yet to drop, too, such as jump in unemployment or even a recession. Unemployment seen rising, inflation still high. Fed Chair Jerome Powell has said that the rapid and forceful action the central bank is taking will have unfortunate costs, including a rise in the unemployment rate currently at a very low 3.7%. Fed policymakers expect it to rise to 4.4% by the end of the next year. Projections released Wednesday show. Earlier this month, Fed Governor Chris Waller warned the Fed will be comfortable with the unemployment rate increasing to 5% before policymakers start to mull any change in strategy. An increase of the degree, which could translate to more than 2 million jobs lost, has historically been consistent with the economy being in recession. For perspective, in the last three recessions, the jobless rate peaked at roughly 14.7%, 9.5%, and 5.5% in 2020, 2009, and 2001 respectively. None of these recession truths were preceded by inflation anywhere near as high as today, a fact that could make a coming downturn more painful. Wage growth slows favor job openings, which grew at a 5.2% annual rate in August, a strong clip, with the lowest paid workers seeing the biggest rise in their pay packets. But that's where the good news ends. Policymakers view that pace of wage growth as too strong to be consistent with the Fed getting overall inflation back to its 2% goal. So they are trying to tamp it down the longer those outsized wage gains continue. They worry then the more likely high inflation becomes embedded in the economy in a self-perpetuating spiral. One reason wage gains have been so strong is fierce demand for a pool of labor that has only just regained its pre-pandemic size. Even as the economy has gotten bigger, the availability of nearly three job openings for every job seeker reflects that, and Fed policymakers hope businesses will respond to interest rate hikes mostly by trimming hiring rather than with outright layoffs. Fewer job openings should translate to slower wage growth, meaning that unless inflation comes down quickly, more workers will see their packets actually shrink after accounting for the hit from inflation. Fed policymakers see inflation now at 6.3% by their preferred measure, falling to 2.8% by the end of next year. Projections released on Wednesday show savings rates will rise, but so will rates on consumer loans. Households will see an increase in the interest rate on their savings accounts, particularly at online institutions. But in general, banks are slow to pass on the Fed's rate increases to savers and do so at levels typically far below the central bank's policy rate and currently inflation. Finance companies will also raise their rates on most consumer and auto loans rates that are generally far above the central bank's benchmark to begin with. Buying affordable, but rents also keep rising. Okay, that's all from me. Thank you for watching. Don't forget to like, share, comment, and subscribe. Thank you.